What's up, everybody? This is Sunko, the Korean bro. Today is 2023, November 20th. And let's get it started, okay? Okay, first, let's see about it. Three stock split stocks billionaires are buying hand over fist. Hmm. First, Alphabet. Okay, let's get it. Among Nvidia, Amazon, Dexcom, Shopify, Alphabet, Tesla, Palo Alto Networks, Moss Beverage, and Novo Nordisk, there are three industry-leading stocks that billionaire investors can't stop buying. While challenges arise on Wall Street, investors have a tendency to turn to profitable, time-tested companies that have handily outperformed their peers. What are that have endeared investors over the past 2 years? A stock split is an event that allows a publicly traded company to cosmetically alter its share price and share count without having any impact on its market cap or operations. Four stock splits reduce a company's share price to make it more nominally affordable for everyday investors, while a reverse stock split is employed to increase a company's share price to ensure it remains compliant with listing rules and major exchanges. Without a question, most of Wall Street gravitates to companies enacting four stock splits. That's because companies enacting four splits are very clearly outperforming and out innovating their competition. Since the start of July 2021, non well known high flying stocks have conducted four stock splits. But not even stock split. Stocks are created equally based on the latest round of Form 13F filings. There are clear winners. More specifically, billionaires, money managers are scooping up shares of very specific members of the stock split group. What follows are three major stock split stocks billionaires bought hand over fist during the September ended quarter. The first stock split stock billionaire investors can't seem to get enough of is Alphabet. Hmm. Specifically, the Class A shares Google. Alphabet is the parent company of familiar internet search engine Google, streaming platform YouTube, and autonomous vehicle company Waymo, among others. All told, non-billionaires were busy mashing the buy button during the third quarter, including total shares purchased in parentheses. The likeliest reason these billionaire money managers have poured into Alphabet is the overreaction investors have had to the potential for economic weakness. Since Alphabet generated nearly 78% of its revenue from advertising, and U.S. gross domestic products grew by a healthy 4.9% during the third quarter, it would appear fears of a meaningful slowdown have proved incorrect. Billionaires likely also value Alphabet's foundational operating segment, Google. In October, Google claimed close to 92% of worldwide internet search share. Moreover, it hasn't accounted for less than 90% share of monthly internet search over the past 8.5 years. It is the undisputed best way for advertisers to target users. And that's going to afford Google exceptional pricing power for a long time to come. But the most exciting growth catalyst for Alphabet is its cloud segment. Google Cloud is the global number three in cloud infrastructure service spending. And enterprise cloud spending is still arguably in its infancy. After years of operating losses, Google Cloud is now generating a profit. Though Wall Street wasn't thrilled with Google Cloud growing by only 22.5% year over year in the September ended quarter, it's hard to argue against the decisive shift to recurring profitability from a potentially high margin segment. Amazon, a second stock split stock the billionaires bought hand over fist during the third quarter is e-commerce behemoth Amazon. A grand total of 10 billionaires added to their respective funds' existing stakes, including, okay, not to sound like a broken record, but the optimism with Amazon probably has a lot to do with the resilience of the US economy. Amazon generates an outsized percentage of its revenue from its world leading online marketplace. When economic downturns occur, it's not uncommon for consumers to spend less, thereby stalling a significant portion of Amazon's top line growth. A healthy US economy reduces near term concerns about retail sales slowdown. However, the smartest investors on Wall Street are aware that Amazon is far more than an online retailer. Whereas Google Cloud is world's number three cloud infrastructure service, Amazon Web Services is number one with approximately 30% of global market share. AWS is pacing more than $92 billion in annual run rate revenue as of the end of September, and its exceptionally high margins mean the segment accounts for a lion's share of Amazon's operating income. Amazon subscription services are also extremely important to its long-term success. In April 2021, the company surpassed 200 million global Prime subscribers, according to then CEO Jeff Bezos, with exclusivity to Thursday Night Football and an ever-growing online marketplace and logistics network. It's a fair assumption that this subscriber count, along with Amazon's subscription pricing power, have both increased since April 2021. Although Amazon isn't cheap based on the traditional price earnings ratio, it's historically inexpensive related to its cash flow potential over the coming years. Tesla, the third stock split stock the billionaires are buying hand over fist, is the most owned stock among retail investors. I'm thinking about electric vehicle maker Tesla, which was purchased by four prominent billionaires during the third quarter, including total shares purchased in parentheses. Billionaires have long latched on to Tesla stock because it's in the driver's seat in the EV space. It's North America's leading EV manufacturer, the only automaker to build itself from the ground up to mass production in more than a half century, and the only pure play EV company that's generating a recurring profit. These billionaires continue to view Tesla as a disruptive force in the automotive space. But while Amazon and Alphabet are historically cheap, at least relative to their cash flow, Tesla is on the opposite end of the spectrum. Despite its struggles to meaningfully expand beyond selling and leading EVs, it's trading at a nosebleed valuation in relation to other auto stocks. This is a potential problem given the headwinds the company is encountering. Specifically, Tesla kicked off a price war with other EV makers earlier this year. Though optimists had hoped Tesla selling its EVs for a lower price was a sign of its improved production efficiency, CEO Elon Musk stamped out his disbelief during his company's annual shareholder meeting by noting that Tesla's pricing strategy is dictated by demand. The more than half dozen price cuts across Tesla's production models in 2023, which have more than halved the company's operating margin over the trailing year, are due to rising inventory and weaker demand. These billionaires may also be playing with fire, given much history of falling failing to deliver, despite overseeing the rollout of four current production models, soon to be five with the Cybertruck. Tesla's chief has a habit of overpromising and under-delivering. If many of Musk's unfulfilled promises are backed out of Tesla's valuation, its stock could head meaningfully lower. Okay, let's go with Amazon first. Super microcomputer. Hmm. Three AI stocks have had good years, but could keep rising through 2024. The AI war got a shock on Friday when OpenAI CEO Sam Altman was fired by OpenAI's board of directors. While the situation appears fluid and Altman may be able to return, it is clearly a less than ideal situation. In the cloud industry, OpenAI investor is thought to have the AI lead because of the OpenAI partnership. But the current chaos may have thrown that lead into question. Meanwhile, Amazon, Microsoft's chief rival in the cloud computing space, is making its own AI moves. September was actually a momentous month for Amazon's AI ambitions. Amazon Web Services made its AWS Bedrock service generally available to enterprise customers. AWS Bedrock service generally available to enterprise customers. Bedrock is AWS generative AI platform. Generative AI platform whereby companies will be able to access large language models from leading AI startups, AL21 Labs, Anthropic, Cohere, Stability AI, and also Meta Platforms, LM, Colima. In addition, Amazon has pre-trained models of its own called Titan, which customers can combine with their own private data to glean insights. Finally, Amazon's AI-powered Code Whisperer helps developers write and implement software code quickly and efficiently with natural language prompts. September also saw Amazon announce a strategic collaboration with AI startup Anthropic. In exchange for minority investment up to $4 billion, Anthropic will commit to using AWS as its primary cloud provider and use Amazon's in-house design train room and inference chips. The deal in many ways is Amazon's answer to Microsoft's collaboration with OpenAI. So we'll see if the Anthropic deal gives Amazon a leg up in the AI wars. And of course, Amazon is an innovative company with a huge scale across its e-commerce, advertising, and other consumer businesses. The size and data advantage should also allow Amazon's other businesses to benefit from efficiency gleaned from AI. And that may already be happening. Last quarter, Amazon's non-cloud North America business grew 11%, and its international business grew 16%, which are very healthy rates for businesses that are large. Given that Amazon is still 25% below its all-time highs, Amazon is a prime candidate for a strong 2024. good enough for Buffett? This forecasting tool has a flawless track record since 1968, and it implies big moves to come for stocks. In addition to the NY fast forecasting tool warning of potential trouble, a couple of important money-based metrics also imply that the U.S. economy and stocks are straddling dangerous territory. Despite these cautionary tales and historic correlations, smart investors are ignoring what could be a lot of white noise in the quarters to come and looking to the future. That's because Tom has a habit of rewarding the patient. If you were to look back to the start of 1950, you see no shortage of corrections in bear markets for the benchmark S&P 500. According to data aggregated by sell-side investment company. Hmm. Okay. Let's see about Shopify. Okay, Shopify. Okay, let's see. Two no-brainer stocks to buy that will make you rich in 2024 and beyond. A get-rich strategy should take place over the long term and include a broad range of solid stocks. Today, Amazon and Shopify offer impressive earnings track records and potential for more growth over time. These market winners have more room to run. This year's stock market rally may spur you to start thinking about getting rich. After all, the goal of investing is to build wealth. The idea of this happening overnight or through buying just one stock sounds fantastic, but it's best not to count on this scenario as it doesn't happen often. Don't worry though, because there's another even better path to wealth. You have to access to it. I'm talking about long-term investing. It's the best strategy because it could lead to lasting riches rather than quick gain that may disappear as soon as the market changes direction. Long-term investing means buying a broad range of stock companies, gradually building up to 25 or more, and holding on for at least a decade. You can start this plan with any budget, even buying fractional shares of higher priced stocks. And over time, you're likely to see your investment grow. If some of these stocks take off right away, you might even feel a bit rich by 2024. Which one should you start off with? Two e-commerce giants are no-brainers because their market leaders have solid earnings track records and could continue to win over time. Let's check out these wealth builders to buy now. Shopify is a secret sauce behind many e-commerce websites you shop on regularly. You know, the company serves millions of merchants worldwide. offering them a turnkey solution for website creation, product sales and payments, marketing, managing their businesses, and much more. This has helped the company deliver a track record of rising earnings, only halted by the expense of building a logistics business. But this story actually turned out well. Earlier this year, Shopify sold the logistics branch, yet continues to use its services. So it's a win-win situation for the e-commerce giant, and we're already seeing the results in earnings. It's a win-win situation for the e-commerce giant. We're already seeing the results in earnings. In the most recent quarter, Shopify reported double-digit growth in revenue and gross profit. Double-digit growth, revenue and gross profit. The period marked its fourth straight quarter of positive free cash flow, with free cash flow margin reaching 16%. That's compared to a negative free cash flow margin of 11% in the year earlier period. So we can see Shopify is growing earnings and transforming more and more of its revenue into free cash flow. The company also offered a bright outlook for the year, saying this trend in rising free cash flow margin will continue, and Shopify forecasts full year revenue to increase at a mid-20s percentage rate. The company also offered a bright outlook for the year. Shopify is a leader in the US e-commerce software market with a 28% share, according to Statista. Is a leader in the US e-commerce software market with a 28% share. Considering this, Shopify's earnings trends and the fact that e-commerce is a highly growing market, there's a reason to be optimistic about the company's future. Even though Shopify's stock has soared this year, its market capitalization remains well below past levels. The revenue has climbed significantly, so there's plenty of room for the top e-commerce stock to grow from here. Shopify stock has soared this year. Its market capitalization remains well below past levels, and the revenue has climbed significantly. So there's plenty of room for the top e-commerce stock to grow from here. Market cap and revenue. And Amazon. Okay, Amazon also has traveled through a rough period in recent times due to the difficult economic environment. This hit the e-commerce and cloud computing giant in two ways. Customers had less money to spend on general merchandise, and Amazon itself faced higher costs. This hit the e-commerce and cloud computing giant two ways. The customers had less money to spend on general merchandise, and Amazon itself faced higher costs. But the company took action, improving its cost structure through job cuts, efficiency efforts, and strategy investment. Already is showing great results. After its first loss in nearly a decade last year, the company now is reporting a profit, double-digit gains in revenue, and huge increases in operating income and cash flow. For example, in the most recent quarter, Amazon quadrupled operating income to $11 billion. And free cash flow improved to an inflow of more than $21 billion from an outflow a year ago. Hmm. Importantly, the moves Amazon has made recently should help it stay on top in the two high growth areas of e-commerce and cloud computing. An e-commerce company revamped its US fulfillment system, transitioning to a regional model from a national one. This cuts down on transport distance, making deliveries faster and lower cost. That's great news for Amazon and its customers. As for cloud computing, Amazon Web Services is making significant investments in artificial intelligence to serve customers who want to use the power of the technology. Significant investment in artificial intelligence to serve customers who want to use the power of the technology without starting from a scratch or managing their own infrastructure. So AWS and Amazon overall could become a big AI winners down the road. Today, Amazon is trading for 54 times forward earnings estimate, which isn't ridiculous for a growth stock and it compares to more than 80 a couple of years ago. Thanks to Amazon's recent efforts, the stock has plenty of room to run, making it a no-brainer to add to your basket of fully potentially wealth-creating stocks. Hmm. Okay, these tech stocks offer strong investment potential in a recovering economy. Universal displays strong R&D focused positions that will afford the post-inflation market rebound. Mm, Okay. One growth stock down 83% about right now. Roku's strong revenue growth could be a sign that digital market is recovering. The secular cord cutting trend should propel Roku for many more years. A cheap valuation makes now a good time to buy the stock. An impressive quarterly financial report has put this business in the spotlight again. Roku recently reported its financial results for the third quarter, during which the business posted revenue of $912 million, up 20% year over year. This key number crushed Wall Street expectations, helping explain why the stock has soared almost 40% since the announcement. Even so, shares of Roku are still down 83% from their all-time high in July 2021. That's after doubling this year. Don't let that scare you away though. Here's why investors should still think about buying this growth stock. Looking at the latest quarter, management pointed to strong performance in content distribution and video advertising along with unit sales of Roku branded TVs. Strong performance in content distribution and video advertising along with unit sales of Roku branded TVs is the primary reasons for the strong quarterly top-line growth. This was very encouraging for shareholders, as company's revenue gain represented a marked acceleration from the previous few quarters. Roku ended the third quarter with 75.8 million active accounts, a 16% rise compared to the year ago period. Streaming hours on the platform increased 22% to 26.7 billion, a sign of healthy viewer engagement. And while average revenue per user of $41.3 showed a 7% drop from a year ago, it wasn't all bad news. The leadership team said that growth of video ads on Roku outpaced the overall ad market in the US. Thanks to cost cutting, the business posted positive adjusted EBITDA of $43 million during the quarter, compared to a loss in the previous four quarters. The goal is still to achieve positive adjusted EBITDA for the entirety of 2024. For the fourth quarter, Roku is expected to post $955 million in sales. That will translate to 10% year over year for growth. Zooming out, when it seems like the economy has never been more uncertain, with investors and consumers still worried about high inflation and interest rates, it's very easy to overly focus on a single quarter's financial results. But for long-term investors, it's absolutely crucial to avoid doing this. Instead, pay attention to the things that really matter for your stock. In Roku's case, it's extremely encouraging the business was able to continue improving on a sequential basis upon its three key metrics account growth, more engagement, and better monetization. A compelling argument can be made that if a severe recession does end up happening, Roku could see its platform become even more popular. In an effort to save money on leisure and entertainment expenses, those could simply stay home, watch more streaming content. This company also benefits from the ongoing cord cutting trend, which households are ditching their traditional cable subscriptions in favor of streaming services. According to eMarket, by the end of 2027, only 35% of households in the US will still have a paid TV subscription. This figure will be down from a 50% share in 2022. Okay, this is it for today, and happy Monday night. Okay, see you and have a good night. Bye bye, everybody.